Now that we have the foundation of the technical aspects of how the market works, how the market trades each and every day, what I want to do is go through a day of the ES from open to close. We're going to look at each of the movements and decipher exactly which technical attributes were prevalent on the charts, using everything we've learned so far to see that the market respects and moves according to everything that we've learned. In between the black lines is 1 day of trading activity. As you can see, from one day to the next, from the close of the prior trading day to the opening of the day we're looking at, the market gapped up slightly. Here's the close of the prior trading day, and here's the opening of the day we're looking at. The first thing we want to realize as traders is when the market opens, it has a tendency to get rather whippy or volatile right at the open. You have traders jockeying for position. You have traders selling positions from yesterday. You have traders that want to establish positions for today. Therefore, my recommendation is let the market open. Let it settle out. You don't have to make a trade right out of the gate. Give the market at minimum of 10 minutes or so of trading just to see it pick a direction or establish itself before jumping into the water. Remember, our objective is to find and enter only the highest probability trade setups that we can find. We're on a 10-minute chart, which means that each candle represents 10 minutes of trading activity. So the market opens and you can see it begin trading and it starts going higher. So as traders, here's the thought process. Item number one is the market going higher but into a resistance point that could potentially be a shorting opportunity? That's possible. We'll get back to that. The second option is the market going to continue to trade higher, and is it a momentum day higher? So we need to understand what the likelihood is of either of those scenarios. The first thing we want to do is find, if it exists, a resistance point. For the purposes of this exercise, let's assume that there is resistance right above this zone here or at this zone here. And we would know that by using the methodologies that were taught throughout this course to where the likely resistance point may be. For the purposes of this exercise, we're going to assume there is resistance up in this zone. If that were the case, then I want to see just how long the market has been rising per candle from the most recent pivot low. Where's the most recent pivot low? It's right here. Now, that was from the prior trading day, but that's okay. The chart is continuous. Just because we started a new trading day doesn't mean we start everything over. If there's a pivot low from the prior trading day, we can certainly use that in our candle count. So if we look at this pivot low where the arrow is, counting that one as number one, how many candles did the market go up into the resistance point? Remember, the market will generally trade in a direction for about an hour, which in this case is 6 or 7 candles. We like the number 7. We also like the number 10. So the market will trade for a period of time before changing direction, changing trend, or changing character. But we're looking for a couple of specific things. We're looking for a tip-off, like a trend change signal. That would be a doji candle, for example. Do we see a doji candle up near the resistance point that we specified earlier? And remember, it's a hypothetical resistance point for the purposes of this lesson. But yes, there's a doji candle. And from the most recent pivot low, that's 10 candles and the doji. So we're always looking for multiple reasons to take a trade. So for example, we have a market that was trending higher for about 10 candles. We have a doji candle that's a signal of a potential trend change at hand into a resistance point. Is that an area where we would be willing to take a trade on the short side? And the answer is yes. And obviously you can see what happened next. The market changed trend and traded downward. What happened next? After the doji candle and the market started trading downward, how long did it trade downward for? About an hour. Also, 7 candles, including the doji and including the next pivot low. If we happen to be short from the doji candle down, the next question we have to ask ourselves is, where might the market change trend again? Where might we want to take some profit? First, we know that if the market trended in a direction for about an hour, the likely scenario is it's going to change trend again. So that's the first clue. But there's also something else on the chart that's extremely important. We have a gap, and the gap was created from the close of the prior trading day to this day's open. And markets like to fill gaps. So it's not out of the ordinary. In fact, it's very common and normal market behavior for any instrument, whether it's the ES, whether it's a stock, whether it's a commodity, it doesn't matter. It's very common for markets to fill gaps. Did the ES fill this gap? You betcha. It filled it to the penny and bounced right off that gap. So here again, if we were short, we now have 2 reasons why we would A, be wanting to take profit at this point, and B, would be expecting the market to once again, on a short-term basis, change direction or change trend. We filled the gap, and we had 7 candles into the gap. From the doji to the gap was 7 candles exactly. So right there, it's very feasible that we could have had 1 trade in the books based on the setup that we just went over. Let's move on and see what other kind of setups might be available for us to consider taking a trade. Now remember, when we have a large down candle, for example, like this one here. Now large is large in comparison to the rest of the candles that are visible on the chart. That's a potential signal that the market wants to go lower. So it's something we want to pay attention to, because as time moves on, we may be in for another trade setup. Now on the flip side, a large green candle will generally mean price wants to move higher. And that's what we saw into the end of the trading day, the prior trading day. We had a green up candle and the market ended up going higher. So it's a signal. It doesn't have to happen that way, but it's something that gives you an indication that the likely scenario is the market's going to want to go higher after a large green up candle. The market's going to want to go lower with a down red candle, a large down red candle. So now we're focusing on the next possible trade setup. We have a down red candle. The market finds a low by filling the gap, but trades sideways to higher following the gap fill. Here we have a bearish wedge pattern developing. You have a down red candle and the market's trading in a sideways to higher fashion, in a wedge fashion, a wedge formation. So we have the potential for a nice risk reward setup. How? If we think or we know that the likely scenario is the market's going to trade lower after the down red candle, what we can do is wait for the market to get toward the top of the red candle. The reason we do that is because the only way that this pattern stays intact is if the market does not close above the high of this red candle. So on a 10-minute basis, if any 10-minute candle were to close above the high of this red candle here, the bearish pattern would be off the table and we would no longer be expecting price to go lower. That's not to say it can't. It's just to say the probabilities are no longer in our favor. So any close above this red candle and we would not be looking for a short trade from that point forward. We would be looking for another trade setup possibility. The reason why this is a good risk reward setup is because if we took a short trade as close to the top of this red candle as we can, then we know where we're wrong. And if we saw a candle close above this red candle, we would move out of the trade. And the likely story is that it would be for a very minimal stop out or loss. Look, we know in trading, we're not going to win 100% of the time. That's an impossibility. So we accept that fact. However, knowing that, what we want to do, our objective is, if we're going to have to lose, and we are going to have to lose at times, we want to lose small and fast. Believe me when I tell you, your first loss is your best loss. When the reason we took a trade changes and no longer exists, then we want to move out of the trade. If we no longer have the probabilities in our favor, then why would we continue to be in a trade where the reason we were in the trade has changed? And the short answer is we wouldn't. So we would move out of the trade. If we were able to get a short off nearest the top of the red candle, it's a high probability trade, and I want to explain why. The market ebbs and flows. It will test numbers. It will test them once, twice, 3 times before potentially breaking through. And the point here is, on the first run up to the top of the red candle, more often than not, in a setup like this where you have a bearish wedge pattern, you're going to likely get at least some kind of a pullback. So even if it was for a small trade, a scalp trade, you're likely to get a pullback from the top of the red candle on the first hit for sure. Obviously not 100% of the time, but the majority of the time. And as you can see, the market traded lower. And then as you can see, the market found some support once again. And where did it find support? It found support right at that pivot low we used from the prior trading day that we began counting candles up to our first trade. Spot on to that pivot low, and the market reversed once again. Your first hit is always your best hit. Meaning this was the first time the market came down to test that low from late the prior trading day. It did find support and began to trade higher once again. The question will come up, is this another trade opportunity on the long side? Could a trader have bought support where I drew the black line? And the answer is you could have, but it's certainly a higher risk trade. And the reason is because we really only had one reason why the market might find support at that level. You didn't necessarily have the proper candle count. We didn't have anything except where the prior trading day's pivot low that we used was. We really need more than one reason in order to take a trade. So in theory, the short answer is yes, but it's higher risk. You're likely to get a bounce higher off of a test of a prior pivot low, like in this example, but it's not the highest probability trade, so we'll leave it at that. We're looking for the highest probability trade setups. However, this candle here is another large down candle into that support area, and once the market did reverse and started trading higher, we could be back in business. How so? The same as before. If the market trades higher into the top of this red candle, the likely scenario is on the first hit near the top of the red candle, you're going to get a pullback. The black line represents the top of the red candle, and as you can see, we got the pullback as the market rose to the top of the red candle. The market challenged the top of the red candle a couple of times, never closed above it, so any trader that was in a short trade from that level could stay in the trade looking for lower prices until and unless the market closed above the top of the red candle. So the market made a down move, traded sideways for a while in a wedge formation, sideways to higher, and then another down move. That completes the move. Remember market symmetry. This was somewhat of a symmetrical move. Now this one is a little bit longer from top to bottom or bottom to top than this one was. However, the concept of a symmetrical move is there. It's never going to be to the tick or to the penny each and every time. It's the concept of market symmetry that helps us trade the markets. Now here's something else you'll find extremely interesting. From the down red candle here, counting that candle, you'll note that until the next red down candle that completed the trade on the downside, that was 14 candles. 7 times 2. 7's an important number in the market. Multiples of 7 is important to the market. This isn't an accident. It's not a coincidence. This is the way the market works. Over and over and over again. And by the wonders of magic, the black line on the right moved over because originally I marked off 2 trading days. We just wanted to review one for the purposes of this lesson. And as the clock runs out near the end of the trading day, it's unlikely we take any trades because we need time. We need time for a trade to work out, so we don't want to take trades too close to the end of the trading day. but you will notice that the market came into this black line here. This sloping black line is a 200 period moving average. The market came in, did a touch of the 200 period moving average, bounced off that, put in a pseudo doji candle, and began trading slightly higher into the end of the trading day. I hope that was helpful, and what I urge each and every one of you to do is the same thing. Go identify a day using a short time frame or multiple days using a longer time frame like a 60-minute chart or any time frame you want, and begin going through the day with data on the chart and understanding how the market moved, and you'll start to see why the market moved. You can't just take my word for it. You have to go look for yourself. And when you do, you'll see the same things that we just went over, and you'll see the same type of patterns repeat over and over and over again. And this will help lend confidence to your trading, because when you have the confidence to enter a trade based on what you know the highest probability thing that should happen next is, that will enhance your trading experience, not to mention the profits.